Trading Lessons from Nicolas Darvas. A professional dancer by trade, Nicolas Darvas had an unlikely path to stock market success. After receiving stock in a company in return for a performance at a nightclub, Darvas became obsessed with the stock market and read over 200 books on investing and the art of stock speculation. After many years of trial and error, Darvas was able to make over $2 million in the stock market. Let's take a look at some of the timeless lessons Nicolas Darvas left for us. Number 1, don't confuse genius with a bull market. Originally a dancer, Nicolas Darvas had no interest in the stock market until he was given 6,000 shares of Bryland as compensation for a dance performance. After the stock rose from 50 cents to close to $2 a share, Darvas began to think that stock trading was an easy way to make a lot of money. This happens to many beginners in a great bull market. However, easy money leaves just as easily as it comes. During a huge bull market, the general market conditions are so strong that amateurs with no real strategy can begin to think they are experts. It's like when I was a kid and we used to play bumper bowling. The employees of the bowling alley would put these big rubber rails near the gutters to keep the balls on track. Kids would wildly throw their balls and somehow would wind up hitting a strike. Once the bumpers were taken away, though, everyone's true ability began to surface. The same thing goes with the market. You can get away with reckless trading in a bull market due to the strong underlying conditions. However, once things get difficult, that is where the true professionals will stand out. The key is to be consistent and to be able to perform when things get difficult. Before you get started trading, make sure you have a plan. Study and do your due diligence before you commit your hard-earned money to the market, and never confuse genius with beginner's luck or a bull market. Number 2, price is the only thing that pays. As Darvas started to learn about the stock market, he initially believed the key was to buy stocks in strong industry groups with low PE ratios and steady dividends. He learned the hard way that stocks that are deemed fundamentally sound can quickly fall lower. He later began to notice that stocks with strong price action usually would head higher even if they had subpar fundamentals. He noted that there is great intelligence to the stock market, and stocks are priced a certain way for a reason. He wrote, "I was fascinated to realize that my buying, based purely on the stock's behavior, enabled me to profit from a proposed merger without knowing anything about it. I was an insider without actually being one." A stock's price is a combination of a multitude of factors such as company fundamentals, macroeconomics, and unforeseen reasons that may not be known for weeks or even months. By strictly following price, Darvas believed he was becoming an insider. Without knowing anything else, the strong action would allow him to deduce that there was something good going on. Don't get too caught up with reasons. Sometimes you won't know until later on. Let the price action and the chart guide your decision-making process. Number 3, buy stocks emerging from sound consolidations. When he began to implement stock charts into his investing, Darvas remarked, "Stocks did not fly like balloons in any direction. As if attracted by a magnet, they had a defined upward or downward trend, which, once established, tended to continue. Within this trend, stocks moved in a series of frames, or what I began to call boxes." Darvas noted that stocks would form boxes as they consolidated. He would buy stocks as soon as they broke out of the boxes they had been trading in. By buying as soon as they cleared resistance, Darvas had deduced that something had changed. For instance, if a stock had in the past found difficulty clearing $100 and now could blast through that area without even knowing the reason, Darvas could conclude that something good was going on. This is a strategy that still has merit to this very day. While many look for beaten down stocks in hopes of finding a bargain, the strongest stocks are those that are near new highs. These stocks have momentum and less overhead resistance. Keep on watch of stocks trading near 52-week highs. Let them consolidate for a few months or so and look to buy them as they clear recent resistance with volume coming in. Number 4, take quick and small losses if a stock moves against you. This is job number 1 for a trader. Cutting losses is by far the best defense a trader has to protect his account from large drawdowns. As Darvas correctly realized, many times a stock will return to prior highs after you sell it, but that is not as important as preventing big losses. Huge losses destroy a trader mentally and financially. Holding one big loser can totally destroy your account. Remember, a stock that falls 50% needs to double just to get you back to break even. And some stocks will never return to their prior highs. Even if a stock does return to its break-even level, it's really not a wise decision to tie up your emotions and your capital just waiting to get back out at the price you initially paid for. Cut your losses quickly before they get out of hand. Number 5, hold your strongest stocks as long as they remain strong. Nicolas Darvas had incredible patience. When he was in a big winning stock, Darvas would refuse to sell it as long as it continued to hold above the low of its most recent box. Even when he was up a large amount of money, Darvas would continue to stick to his plan and refuse to sell a stock as long as it was trending higher. When studying a chart of a monster stock, you can look like a genius merely holding as long as the stock trades above key moving averages and support levels. An absolute fortune can be made doing this. Make a plan to hold your winning stocks longer than your losers. Hold on to them as long as their upward trend remains intact and exit them quickly as soon as they reverse. Number 6, winning streaks can be dangerous. After running up his account to over $500,000, Darvas entered his most reckless period of trading. He noted, "The most dangerous time is after a period of success." The truth was that as my pocket had strengthened, my head had weakened. I became overconfident, and that is the most dangerous state of mind anyone can develop in the stock market. It was not long before I received the bitter lesson the market always hands out to those who think they can carelessly master it. This happens to many traders. Having seen their account grow during a bull market, they begin to think the good times will last forever. They may even begin to believe that they are geniuses. However, it's important to remember that nothing lasts forever. When you start to feel giddy or to believe that you can quit your job to become a full-time trader, use that as an indication that the bubble you've been trading in may just be about to burst. Number 7, persistence leads to greatness. Nicolas Darvas devoted enormous amounts of time to perfecting his craft. $2 million did not simply fall into his lap. He studied the market to look for patterns. He developed a system for buys and sells. He kept a trading journal to study himself and his trading results. This is the type of dedication it takes to become a success on Wall Street. Just as a bodybuilder must commit himself to a lifestyle of training and dieting, a trader must discipline himself to follow his rules and to keep his emotions out of his trading. Studying past market leaders will help you understand their general characteristics and how to handle them. Likewise, studying yourself will help you to notice trends in your trading. Keep a journal so that you can keep track of your reasons for buying and selling. Later, you can go back and review your decisions to see if you notice any patterns developing. Number 8, look for innovators. Wall Street loves growth, and that often means that stocks that are innovating and coming up with new and exciting products are often likely to be the biggest winners. Take Tesla in 2020. Here's a company that has totally revolutionized the automobile industry. Not only have they been able to mass produce electric vehicles, they have made them trendy in some of the most sought after cars on the road. Same thing goes with Apple in the early 2000s. First, they totally transformed the music industry with iTunes and the iPod. Then, they ushered in a new era of cell phones when they released the iPhone in 2007. Is it any surprise that the stock is up more than 300 times since 2003. The same can be said for Netflix and Amazon, which totally changed how people watch television and do their shopping. While I agree with Darvas that it's not practical to believe you will hold a stock for 20 years, I do believe it is wise to be on the lookout for new and exciting industries and for leading stocks in those groups. When you start to hear about a new and innovating product, pull up its chart and see how it looks. You may just be on to the next big thing. Number 9, tune out the noise. As a professional dancer, Nicolas Darvas had to travel often, and for much of the 1950s, he was living in different parts of the world. Without the internet or modern technology, Darvas relied on his broker cabling him stock quotes so that he could become aware of what was taking place on Wall Street. He initially believed this was an obstacle to his success and believed being closer to the market would yield even greater returns. However, setting up in New York was an absolute disaster for Nicolas Darvas. He wrote, "In a few days of trading, I threw overboard everything I had learned over the past 6 years. I did everything I had trained myself not to do. I talked to brokers. I listened to rumors. I was never off the ticker." It's important to keep your trading insulated from noise. Between Twitter, Instagram, CNBC, and countless other distractions, it can be easy to get off track. Don't fall into this trap. Let the price action of the stock guide your decisions, and don't let anything else cloud your judgment. As Jesse Livermore stated, at the same time, I realized that the best of all tipsters, the most persuasive of all salesmen, is the tape. That statement is just as true today as it was when Jesse Livermore and Nicolas Darvas were trading many decades ago. Number 10, listen to the market. While developing his box theory, Darvas did not realize he had inadvertently developed a system to help time market tops. In his book, he wrote, "Finally, on August 26, 1957, I found myself without a single stock. My automatic stop loss had sold me out of everything. In 2 months, every one of my stocks had slowly turned around, and one by one had sagged through the bottom of their boxes. And one by one, even if it was only a question of half a point, they were sold. Eager and anxious, I watched from the sidelines with not a dollar invested while prices continued to drop, but no opportunity seemed to appear. What I did not know was that we were at the end of one phase of the great bull market. It was several months before this became evident, and it was declared a bear market. Although getting stopped out can be frustrating, it is important feedback. If the stocks you own are breaking down, or if there are no stocks breaking out, that may very well be a sign that the market is weakening. Rather than doubling down after a loss, listen to what the market is telling you. If your trades are not working, or if there's a dearth of setups, the market may be entering a correction or bear market. Nicolas Darvas remains one of the greatest traders who ever lived. While most will recognize him for his box theory, I believe one of his most lasting contributions is that he showed that anyone, no matter what their profession, can make big money on Wall Street as long as they have the patience and discipline to stick to their trading rules. Although Nicolas Darvas passed away many decades ago, his trading principles are timeless, and his story will continue to inspire and educate traders for years to come.